A growing anxiety is moving through the financial world. The fear that the current tech boom is a precarious, top-heavy structure, one slight misstep away from a total collapse. This fear rests on a specific assumption, that the entire global market is being artificially propped up by a handful of massive AI and tech companies. However, a leading contrarian voice in the market argues that this hyperfixation on AI is blinding us to what is actually happening. Obsessing over AI valuations creates a distraction. By looking only at tech, we risk being entirely unprepared for the structural shifts occurring beneath the surface. The data suggests a different story. In international markets with zero AI exposure, major industrial hubs are quietly hitting all-time highs. By sheer volume, the steady rise in these non-tech sectors outweighs the isolated tech spike. This is a worldwide movement, not just Silicon Valley. If the world were truly trapped in a narrow AI bubble, these unconnected global markets would not be participating in this rally. Because this growth is happening globally without the help of AI, the premise that we are in a fragile tech-only bubble begins to fall apart. The reason for this global participation comes down to market breadth. It's a measure of how many different companies are contributing to a rally, rather than just a few heavyweights. A one-theme rally is fragile, like a platform balanced on a single pillar. A rally with high breadth, however, is supported by dozens of distributed columns, giving the entire market immense structural resilience. In this framework, AI serves as the highly visible hood ornament on a much larger, diversified global machine. This widespread participation creates a resilient floor, making a sudden, catastrophic market collapse highly unlikely in the near term. If the foundation is this strong, we still have to ask why caution is necessary. To understand the psychological health of the market, we have to look to the legendary investor John Templeton. Templeton mapped bull markets into 4 stages: born on pessimism, growing on skepticism, maturing on optimism, and dying on euphoria. We recently climbed a wall of worry, growing despite global conflicts, the pessimism and skepticism phases. Today's broad participation moves us firmly into optimism, but a specific red flag has appeared. The Cerebras IPO saw a company reach a massive valuation based on future manufacturing promises rather than its current size. This IPO acts as a symbolic marker. It captures the moment when healthy optimism begins to shift toward the speculative high hopes that define early euphoria. Recognizing that we are in the late stages of a cycle can be uncomfortable, but late is a description of the phase, not a prediction of an immediate end. The Templeton cycle teaches a counterintuitive truth. Markets rarely die because of sudden bad news. They die because investor sentiment starts to feel entirely flawless. This final euphoric phase can often stretch on for a long time, heavily supported by the global breadth established earlier. The primary risk today has shifted. The danger is no longer a general economic collapse, but the localized, speculative overconfidence forming in specific corners of the market. Moving forward, we can translate this psychological map into a practical strategy for observing market health. If this global cycle begins to fracture, the damage will show up first in those specific tech and AI stocks with incredibly stretched, hype-driven valuations. Stretched valuations are not a signal to panic sell today, but their behavior serves as the leading indicator for a broader shift. The global bull market still has room to run. But when the music inevitably changes, those names most disconnected from reality will be the very first to break.